afternoon and welcome to BizTech's Asian Midday Market Watch. It's 20th of July, it's a Thursday, and we have our regular guest today, David Kuo, founder of the Smart Investor out of Singapore. David, as always, great to have you on the show.
Selamat tengah hari, Brian.
Selamat tengah hari. Now, David, before we get your insights, let's take a look and see how markets across the region have performed. We're going to start with crypto markets. Bitcoin is at dipped below the 30,000 mark. It's 29,975. It's down 0.42%. Ethereum is at 1,896. It's down 0.8%. Now, looking across the regional equity markets, we start where you're at, David. The SGX is trading down 0.02%. Bursa Malaysia is up 0.28%. Shanghai is down 0.34%. The ASX All Ordinaries is down is up 0.13%. The Nikkei is down 1.07%. The Hang Seng is up 16%. And rounding up the numbers, we have the Kospi, which is down 0.12%. It's a pretty mixed bag, David. Tell us why.
Pretty flattish as well. Yeah, you would have thought there would be some follow-through buying given the another strong session over in the US. But I think US futures are indicating that the market could be a little bit on the softer side. So I think that is probably what's happening over here in Asia. But the more interesting question that I would like to address, Brian, is why is the US stock market as strong as it is? When we hear about all this bad news about interest rates, when we hear about economic downturns around the world, and this tension between America and China is still going on, why in heaven's name is the stock market still on a tear going up? And maybe we can shed some light to your listeners as to why that is happening.
And that's something that we want to address right now, David, because I've been scratching my head and humble me, who is a humble journalist, can't figure this out. Maybe you can unpack this for us and tell us, why is the market going up? Are people plowing into the market in anticipation that we've hit the peak terminal rates for interest rates and rate cuts are just around the corner?
That could be one reason. I mean, it could be one reason. I mean, we have to compare what's happening now with last year and the year before, when the stock markets were really sort of, I wouldn't say rock bottom, but definitely in the doldrums. And maybe there is some anticipation that things are beginning to look better now. I mean, this time last year, people were talking about double-digit inflation rates and all that. And as it turns out, the inflation rate isn't quite as bad as that. And so maybe you could be right, Brian, that maybe people are beginning to think that this is about as far as interest rates will go, and maybe the Federal Reserve won't have to increase interest rates nearly as severely as people thought. But there's still this other question about the economic downturn. Are we going to, or are we not going to have a recession? And that is still hanging in the balance. We may have an economic downturn. We may even have a recession. But what's interesting, Brian, is that it's always driven by results, right? And we have quarterly results from a whole bunch of banks at the moment. And when you have a look at how they're doing, the answer is not that badly. And then we have a look at some results from consumer goods companies such as PepsiCo. They weren't that bad, Brian. I mean, they're actually sort of making quite good money. So maybe people are thinking, okay, we may get an economic downturn, but at the same time, if we have a look at these companies and we have a look at the profits that they're generating, I want a piece of that action. I want some of that. And maybe these companies are able to navigate any kind of economic distress that may be in the market. We saw that with PepsiCo. I mean, they were able to raise prices. They were able to raise their margins. And it is quite extraordinary when people were saying, oh, do these companies have pricing power? Do they know how to handle this? And I just want to remind them, PepsiCo's been around for a long time. I mean, they've seen a lot of recessions. They've seen a lot of high inflationary conditions. And they know they have the playbook. I mean, they just bring out the playbook and they go, how do we handle this, right? What do we need to do? And it includes things like shrinking the can of Coke, putting less liquid in the Coke. So their volume sales fell, but the profit margins increased and their profits increased. And when they announce their next set of dividends, it'll be better than this time last year. So I don't think people need to worry too much about it. But ultimately, it will always be the profits, the earnings that the companies make that will drive share prices. That's always the case.
But from a global, and let's take a step back from and take a global lens. The global engine for growth was supposed to be China. It has not happened. In fact, the China story gets uglier and uglier as the weeks go by. So China has just announced today that it's going to keep all the key rates unchanged. However, the China's Commerce Ministry warned that the country's foreign trade was faced, and I quote this, extremely severe situation in the second half of this year. Um, there's also talk that because of the challenges in the property market, that there's going to be stimulus around mortgage rates and so forth. So, and the Chinese consumer is not spending, the Chinese consumer is not traveling. So that engine for global growth is not happening. So, David, how do we as investors take care of that? Now, particularly because a lot of economies have China as their number one or number two trading partner.
Well, I was listening to one of your shows this week, and I think the answer lies in the fact that India is probably going to be the new China. Yeah. And instead of looking at what is going on in China, I think China would just start to plateau. And all that extraordinary growth that people were expecting. And one of the problems with when people make predictions is they have 2 points on a chart, A and B, and then they extend that and they project that forward and they think, oh, point C is going to be higher than point B. And because China has grown at 10% previously, we're going to actually sort of repeat that the next time and the next time and the next time after that. It doesn't quite work like that. And so what I think we will probably see is that growth in China will start to taper off. And we already know that double-digit growth of the past is something that we are not going to be expecting in the future. And that if we're lucky, we might get 5% growth in China. I mean, China is becoming a mature economy. So for people who want to look for a little bit of excitement in their portfolios, they should be turning away from China and looking at places like India, which definitely has the same size population as China, and it probably has a lot more prospects. But going back to your question, I'm not trying to avoid or evade your question, Brian, in any way. But yeah, China has a problem. And they also know that the engine of growth in China has to be the consumers. The consumers are not putting their hands in their pockets and spending money. Why? Because they're having this sort of negative property, this negative wealth effect that is affecting them. So China thinks that, well, maybe the way we actually address the problem is to boost the housing market, boost property prices, try and increase the amount of demand for property, and then that will start to absorb the excess properties that they have in the market. And maybe, if they were to do that successfully, then people would feel richer and they would feel more confident to go out and spend money and then drive the economy forward. But there is a danger in that. And when I have a look at China and I have a look at the property market, I just think that is the wrong way to go. We know you have an excess of properties for sale on the market. People are not buying it. But to lumber people with debt and to say that we'll make it easier for you to borrow money to go and buy the property, the P word comes to mind, and it's called the Ponzi scheme. And I just worry that it's the wrong thing to do. And you have to let the market sort itself out, no matter how painful it is.
So, David, on the other side, since we're talking about property, one piece of news that came out today, which obviously impacts the property market in this economy, is the fact that Australia's unemployment rate for June actually fell to 3.5%. Now, this is despite the fact that the Reserve Bank of Australia has been hiking rates repeatedly in order to cool demand. There is a real shortage on the ground in Australia in terms of in tightness in the labor market. But also, there's on the flip side of the equation, you have pain in the property market. which is 20% of Australia's GDP, because many people borrowed at 1% rates, and the mortgage rates have now increased dramatically. And many people will have, in the last few months, had their mortgage rates reset because they were either on floating rates or they were on 2-year fixed rates. What is your take on then the Australian market, and how would we as investors play that scenario?
Do you know what, Brian? I think we are still, despite the fact that the pandemic is now behind us, the COVID-19 is now behind us, I think we are still grappling with many of the issues that were caused as a result of the pandemic. And many economies, many governments are still trying to work their way through. They're still trying to figure out what exactly they need to do. And at the risk, right, of being accused of being flippant, the Federal Reserve was right to a certain extent when they said that the inflationary pressures were transient, right? It seems like a dirty word to use at the moment because inflation does seem to be fairly entrenched, but there was a transient part to that. And that was the part that many of the central banks had to tackle, because they knew that if they didn't tackle the transient part of the inflationary pressures, then that could actually sort of cause problems later on. So many central banks started to hike interest rates just to tamp down on that kind of demand that was in the market. And also we have to remember that many economies were locked down for 1 year, 2 years, if not longer. And people had a lot of excess cash that they were deploying. So as soon as the doors were thrown open, as soon as people were able to go out, they started spending. And that was also another cause for inflation. So I think what we need to do now is to sort of take a step back. And will interest rates continue to rise in Australia? It may very well do. If you have a tightening labor market, then of course people who want that labor force, who want those workers, will have to pay more, and that is the danger that they have. So, can we call time on interest rate rises in Australia? I think probably not, but they do need to take stock of where they are now and where are the inflationary pressures, where are the pressure points within the economy, and then they will have to decide whether or not they need to continue to increase interest rates if inflation doesn't come down on its own. But the big danger, of course, is the entrenched inflation, because the moment workers start asking for higher wages, well, you can't take it back afterwards, right? Once you've actually given them, and you have a look at the UK, people are asking for ridiculous amounts of increases in terms of their wages. And once you give it, you can't take it back. And that is the danger that we have. So my answer is we're still working through the pandemic, even though it's behind us, and it will take a long time before things start to settle down.
David, on that note, thank you very much for your insights. Thanks for coming on the show this Thursday.
Thank you.
Now, we've been speaking to David Kuo, founder of the Smart Investor out of Singapore, on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. This show will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.